Yields on Treasuries slipped Thursday morning, led by 10- and 30-year maturities, as investors monitored developments around Ukraine and continued to weigh the outlook for Federal Reserve interest rate increases that are expected to begin next month. What are yields doing? The yield on the 10-year Treasury note TMUBMUST 10Y, 1.973% fell to 1.99%, down from 2.044% at 3 p.m. Eastern Wednesday. The 2-year Treasury note yield TMUBMUST 02Y, 1.482% was at 1.495%, compared with 1.527% on Wednesday afternoon. The yield on the 30-year Treasury bond TMUBMUST 30Y, 2.280% was 2.299%, down from 2.364% late Wednesday. What's driving the market? Jitters over Ukraine triggered some renewed buying interest in traditional safe haven assets such as treasuries, analysts said. Read, here's the technology being used to watch Russian troops as Ukraine invasion fears linger. Pro-Russian separatists and Ukrainian authorities traded accusations of ceasefire violations along the line separating the two sides on Thursday. Flare-ups along the line have been a frequent occurrence, but concerns run high amid a buildup of Russian troops near Ukraine. U.S. officials have previously charged that Russia could use false claims of Ukrainian attacks on pro-Russian separatists as a pretext for invasion. Fears of a Russian invasion had ebbed earlier this week when Russia said it was pulling some troops back from the border with Ukraine. But U.S. and NATO officials said there were no signs of a pullback, and a senior Biden administration official said late Wednesday that Russia had instead increased its forces by 7,000 troops. Meanwhile, minutes of the Federal Reserve's January policy meeting published Wednesday afternoon offered investors little new information. The minutes showed officials felt it would soon be appropriate to start raising interest rates, as signaled by Fed Chairman Jerome Powell and the policy-setting Federal Open Market Committee's statement at the conclusion of the January meeting. The minutes also showed a couple Fed officials backed ending the central bank's bond buying before the planned end in mid-March to send an even stronger signal of a commitment to bring down inflation. Data released Thursday showed U.S. weekly jobless claims rose by 23,000 to 248,000 last week, breaking a string of weekly decline. Economists surveyed by the Wall Street Journal had been looking for first-time applications to fall to 218,000 in the week that ended February 12. U.S. home builders started construction on homes at a seasonally adjusted annual rate of roughly 1.64 million in January, representing a roughly 4% decrease from the previous month. Permitting for new homes occurred at a seasonally adjusted annual rate of 1.9 million, up nearly 1% compared with December. And the Philadelphia Fed's manufacturing index fell to 16 from 23.2 in the prior month. St. Louis Fed President James Bullard, who has called for 100 basis points worth of rate increases by July 1, is due to speak at 11 a.m., while Cleveland Fed President Loretta Mester is expected to speak at 5 p.m. What are analysts saying? With no relevant macroeconomic data releases scheduled for today, the focus will remain on possible news relating to Russia-Ukraine tensions and speeches by central bank officials, said analysts at UniCredit Bank, in a note. The publication of the FOMC minutes had no substantial impact on market expectations on the future rate hike, with investors currently pricing in roughly a 35 BP Fed funds rate hike at the FOMC meeting scheduled for March 16, they said. The decision of whether to raise the Fed funds rate by 25 BP or 50 BP in March will probably depend on the economic data relating to February, in particular non-farm payrolls and CPI inflation. In the meantime, short-dated UST yields will likely remain very sensitive to any remarks by central bank officials.